Hello. Welcome, guys, to Futures Trading Made Easy. This is the voice of Ken Akure, and I'm delighted to have you here in today's session. Today, I want us to take a look at the three dimensions of trading. Now, everyone gets into trading with a singular purpose of making a profit. Let me say as much as 95 or 99% of people that come into trading come with the hope, with the expectation that they're going to be able to trade the market and make money. But in the end, only about 10 to 20% end up making money. And sometimes for some people, it is because they don't even understand the three dimensions of trading and how to position themselves accordingly to the one that suits them the most. So that's why in today's class, we'll be looking at the three dimensions of trading. And by knowing each of these, you can know which one you're functioning in at a particular time. And if you are veering off on the path that might not be too good for you in the long run. So the first dimension of trading is what is called mechanical trading. Now, what is mechanical trading? Mechanical trading is where you have a fixed trading strategy that you use, on the particular account that you're trading. So the strategy might be that, okay, if you're trading, let's say, okay, let me share uh, this. Okay, let me share this. So yesterday, in our previous class, we looked at how to define an edge. Now, you've defined your edge. I'll only buy if these rules are fulfilled, and we came up with the rules for placing a buy trade, and we said to buy, uh, this market, this must happen, price must be or around an area of support, you tick that. Price must be above your market baseline, you tick that, or coming around your market baseline. Your oscillator has to be either oversold or away from or around your pullback area or your middle level pullback region. So once you have that, then you have 2/3 of those factors, you can take a trade. Now that is mechanical trading because you're following specific rules. You are not trying to think on your own what the market is doing. The reason for creating these rules is to eliminate the need to think on what you think that the market is doing at that time. You have already taught it in the past. You created a trading plan. In your trading plan, you had trading rules, entry and exit rules, and all that. Then so when you're in front of your chart, you are only looking for those rules that I have created. Are they present in this market? Are they available on my chart now? That's the only thing you're looking for. So if they are available, you take the trade, you set your stop loss where it's supposed to be, you set your first take profit where the next, if you're buying now, the next level of resistance and the next level of resistance, you do all that. Why? That is what your edge dictates that you do. So for following that strictly and religiously, you're trading based on the mechanical model or the mechanical dimension of trading. It is mechanical because you're not trying to invent new things or use other things that you know about the market. You might know so many things about the market, but then you're only focused on executing this particular trading checklist that you have. So if you're doing that, it is said that you're undergoing mechanical trading. So that's that for mechanical trading. Then uh, the next one is what is called the subjective dimension of trading or the subjective model of trading. And in the subjective model of trading, you use everything you know about the market. You don't have fixed rules with which you say, oh, let me follow these rules strictly. For example, in subjective mode, let's share screen again. In subjective mode of trading, you even though you have these rules, you don't actively go over these rules. Why? You know so many other things about the market that maybe tells you, oh, this is what the market is doing right now. For example, if you are trading based on these rules, it means that you shouldn't even be buying around here. Why? Even though price is an area of support, it is below your baseline. Okay, let's say your TDI is even, okay, your TDI is aligned, so you can take this trade. But in some other cases, you are not even supposed to take this trade because it is below your baseline. You know, it's below your baseline, so you shouldn't be buying. You should only be waiting to sell at resistance. But then if you know in the subjective level, you know what you're supposed to do and the other rules, but then you add other rules based on what you know. For example, you can say, oh, because Bitcoin got, sorry, this is ADA, because ADA got to this level, 1.03, then is the key level of support. Even though my main trading rules say I shouldn't be buying when price is below my baseline, I should only be selling, you know, I'm going to take this trade for a buy. Otherwise, why? Because I'm applying other things I know about the market, that when the market is overextended, when the market has oversold, it always retraces back to the mean or back to resistance. So I'll trade that instead of waiting, for these rules and I'm following to align. You could also see this pattern and say, okay, this is a chart pattern called inverse head and shoulders. So you can say this is head, this is shoulder, this is shoulder. So this is an inverse head and shoulder. This is a slanted neckline. There's a break above here. You take this trade, the stop loss comes somewhere here. There's a pullback, but then market still went in your favor. So if you trade this, you're trading subjectively. Why? Because the main trading rule that you have, you are not using that now. You are not using everything you know about the market. Everything, everything. If you see a complex pattern, let's say this is an inverse head and shoulder again. No, this is a normal head and shoulders. You take these two. This is a double bottom. You take that. Why? You are applying all the different things you know about the market, and you are not saying I must follow these rules strictly. I must follow one particular rule or two particular rules strictly. You can trade anything that looks like a pattern that you're familiar with. And you can trade so many different strategies, up to 10, up to 15 different patterns. You can just trade because you are familiar with these things from your exposure to the charts, from the different times you spent on the charts. So instead of waiting for that unique one edge or two edges or strategy that you want to rely on, you now choose to do anything that you feel that suggests to you from other things you've learned about the market in the past, that it looks like this market will buy from here. So that's what you do in the subjective dimension or model of trading. Then the final one, and actually the most advanced one, is so advanced that many of us in the course of our trading career we might never experience this. We might just maybe experience it once in a while, but it will never be something that we can fully depend on. And that one is called the intuitive or spiritual level of trading. I call it, I was the one that termed this word spiritual. The main word is actually intuitive or instinctive, using your instincts, And in intuitive, it goes beyond just technical analysis. It goes beyond technical analysis. It goes beyond having the mind of the market, being able to see into the mind of the market before it even plays out. That is what intuitive trading is. Like you can sometimes you're sleeping and you just say, oh, go and buy that coin, go and look at that chart now and take a buy. So you are led to the charts. Sometimes you might even have a dream about it. As you wake up or you see a particular coin going up, go and buy it. Do you understand? That's intuitive. Like there's a voice leading you to do it. It's intuitive. Does it work all the time? Sometimes some people feel they are doing intuitive or spiritual trading when they are projecting their own greed or their own bias onto the market. So sometimes, because you really want a coin to pump, you might sleep and you're having a dream that the coin is pumping or the pair is going up. Why? Because you want it to go up. You want it to go up so that you make money. So you are now selfishly trying to impose your own bias into the visions you're having or the dreams you're having, and you think you are actually functioning in the intuitive level. No, you are not. So a lot of people mix them up. So because of the level of complexity that this has, it's not advised that you say, oh, I must rely on this. Why? Because it takes a whole lot of discernment for you to know, oh, at this point, it is not my mind that is telling me. It is actually the market that is whispering to me that it's about to move. This is about to happen. And if you follow the real intuitive voice, it hardly goes wrong. It hardly goes wrong. If you take a trade that you felt you dream about and it didn't work out, most times that wasn't coming from the mind of the market or from your own mind. It was you who was imposing what you wanted to happen on your mind. And you now felt as if you are having a vision or a dream or an intuition to go and buy a coin or buy a trade or close a position or act in a certain way. So based on that, you are not even advised to begin considering this. Even this can be confusing for a lot of people. But the easy one that you can easily track your progress is the mechanical one. Why? This subjective has to do a lot with thinking. You are thinking about the different things you've learned about the market. So if you've learned about Elliott waves, those things you've learned will come to mind. If you learned about harmonics, Elliott waves, we call it EW. If you learned about harmonics, there's something called harmonics in trading. If you learned about harmonics, harmonical patterns will come to your mind when you see them. If you learn about false breakouts, beat the market maker or the dealer, those patterns will begin to come to your mind. Beat the market maker. Those patterns will come to your mind. You talk about chart patterns, M's, W's. So you have a whole lot of these coming to your mind at the same time. You are now reasoning, trying to decide which one is more appropriate in this situation of this market right now. So by the time you start doing all that reasoning, you've entered the subjective level of trading because you're thinking, you're reasoning, you're rationalizing, you're thinking, oh, in subjective, it can become so complex that instead of usually risking 50% on your, 5% of your account on a trade, you could even decide that, oh, no, on this trade, I'm going to risk 30% of my account. On the next trade, I'm going to risk 10% of my account. On the next trade, I'm going to risk 50% of my. So there's no systematic way you're following. You're just following it based on the confidence you have on the different setups that are appearing to you on the chart. So this is actually a more advanced level to this, and this is more advanced. So for me personally, if you're starting out as a trader, I tell you to even delete these two. Don't even assume they exist. Focus on this one solely, because sticking to these two, sometimes it's difficult to track your progress. You might have 1 month or 2 months or 1 year or 5 years that you are in the zone. So you are just following the subjective and intuitive. You are just flowing with the market, making a lot of money. But then one mistake or two mistakes or a series of mistakes can just set you back straight to square one, right where you started. Have you not seen people that they've grown an account from $1,000, to $30,000? They've grown it, they're excited. I'm taking this $30,000 now to $100,000. Then all of a sudden they crash. They go from $30,000 straight down to $2,000 in a very short period. And you're wondering what happened. What happened? They were trading subjectively. Their risk management was subjective too, based on how they felt about the market at that time. How they felt that, okay, this thing I know about the market, I think that's what is playing now, and it will surely play out. So instead of risking 5%, I risk 20. So because they were not following this kind of strict rules that protect them in case your mind is messed up. Why? Because in this subjective, you can't afford for your mind to be messed up in any way at all. You can't allow family issues, girlfriend issues, landlord. You can't allow any kind of issue to flow into your mind, right? Because then it will now distort how you perceive the information in the market. And that will cause you to do errors. So to stop doing all those errors, you pick maybe two strategy. One for uh, trending markets, then the other one for trending markets, then the other one for ranging markets. And you write out the rules that you follow. You write it on paper or on Excel sheet. You actually write it out. The rules for each. You write rules for this one too. You write it there. So before you enter any trade, you go over those rules before placing a trade. So by doing that, you're trading mechanically. You are not trying to come up with these rules at the moment you're about to enter the trade. No, you are following the rules. So it's either the rules are on the chart, is either the trade you're about to enter meets those rules or doesn't meet those rules. If it doesn't meet those rules, you don't take the trade. If it meets those rules, you take the trade and you follow the risk parameters for those trade, and it has to be consistent. If you're risking $5 on, sorry, 5% of your account on one trade, it has to be 5% across board on all your trades until maybe you finish a particular trading sample size. I usually advise 20 trades makes a sample size, or 25 trades make a sample size, but no more than 25. You know, no more than 25. Then at the end of each 20, you count how many trades were winners and how many were losers. Then you do your review. What did I get wrong? What can I improve on? What is my state of mind? But you're following this 5% rule. So that stops you from making a big error in your equity if something just happened and you're not trading properly, you're not following your edge properly. Still this 5% rule will protect you, unlike in subjective that you can even decide to use 50% of your account on a trade. Why? Because this setup is looking so juicy. So if you are right, you make a whole lot of profit for using 50%. But then if you are wrong, then village.io. So those are the three dimensions of trading, and I've told you which one to focus on for now. What flow into this level comes naturally. It comes with experience, it comes with time, it comes from being in a level where you're so comfortable with the market that you can flow easily with the market without having any fear, any expectation, from the market. You are just enjoying the game in a way that even if money was not on the line in your trading, you will still be excited doing it. That's how you now begin to get into this level. But with this level alone, it is more than enough to make you a consistently profitable trader in a way that you can never completely blow up, get liquidated while you're following these strict rules. Thank you guys for joining this session. I hope you make use of this information. See you in the next one. Cheers. Ken out.